These talks are brought to you by Claritax Books and are proudly sponsored by Six Forward Capital Allowances.
Welcome back to our series of talks on capital allowances. Last week we looked at the definition of car, and this week we'll consider some of the special rules that apply. If a vehicle is classified as a car, one of the first consequences is that annual investment allowances are not available. So the owner of a motorhome that is used for business purposes will be denied AIAs, as will most taxi drivers. On the other hand, drivers of London's black cabs will be able to claim AIAs, as will driving school instructors if their vehicles have dual controls, as those vehicles are in each case not classed as cars. Given that AIAs, and in the overwhelming majority of cases first-year allowances, are generally denied for cars, capital allowances are instead given by way of writing down allowances. The rate at which WDAs are given is dictated mainly by the level of emissions produced by the vehicle when driven. So the tax rules are used to motivate employers and others to buy cars with lower emissions, rewarding such behaviour with earlier tax relief. For company cars, of course, lower emissions also lead to a lower benefit-in-kind charge. To achieve the desired outcome, expenditure on cars is normally allocated either to the main plant and machinery pool or to the special rate pool. In broad terms, electric cars and cars with emissions of up to 130 grams per kilometre are called main rate cars and attract standard allowances, while cars with higher emissions are treated as special rate expenditure and thus attract a slower rate of tax relief. Where there is private use of a car by a business proprietor, the cars are allocated to individual, single asset pools so that the necessary adjustments may be made. Short life asset elections are not permitted for cars. As the expenditure is pooled with other assets, the sale of a car does not normally produce any balancing allowance or charge. Instead, the proceeds simply reduce the value in the ongoing pool. The practical effect of this is often to delay the timing of tax relief, as cars, especially those with higher emissions, generally depreciate at a faster rate than the rate of writing down allowances. Various anti-avoidance rules apply to prevent manipulation of these restrictions. HMRC still take the view that very expensive cars may be subject to a restriction of capital allowances if there is blatant incongruity between the asset provided for the director or employee and the commercial requirements of the business. This is based on the principles brought out in the Northiam Farms case back in the 1950s. However, the legislation has moved on considerably since that time, not least with the whole regime for taxing benefits in kind, and there are grounds for arguing that the principles from that case would no longer apply today. A final point to remember in relation to cars is that employees and directors are not able to claim capital allowances for cars, or indeed for vans or bicycles, even if they are used for business purposes. In each case, an employee may instead claim tax relief by using the system of authorised mileage allowances and relief. Employers, of course, may claim allowances for cars owned by the business but driven by directors or employees, and no adjustment is made to the capital allowances computation for private use of the vehicle in such circumstances. Next week, we'll take a look at the new topic of contributions to capital expenditure, which raises issues both for the contributor and for the person on the receiving end. Thank you for watching. I'm Ray Chidell, author of Capital Allowances and of the A to Z of Plant and Machinery from Claritax Books. This talk was sponsored by Six Forward, an independent property tax consultancy working with accountants to enhance capital allowances for their clients.